The market this week has shown some weakness. As we can see, the majority of stocks are down unless you are a holder of some of the big tech names like Google, like Amazon, like Tesla. And today we are focusing on insiders who have been buying a lot of shares in their own companies. We're going to take a look at 5 massive buys. We'll look at each one individually. We'll have a very quick look at their historical performance, see what the analysts are considering, whether they also, like the insiders, believe it is a buy, and we'll also very briefly touch upon some dividend safety scores just to ensure that these companies do have the sustainability for keeping that long-term dividend income. We're then going to do at a very quick review a valuation analysis. What is our intrinsic value? What is our acceptable buy price? And see if Wall Street do have enough upside for us that does make it an attractive buy in today's episode. So the first one that we are looking at, it is Exxon Mobile. As we can see, the director did buy on the 17th of June, so around 10 days ago, over 18,000 shares for a total of $2 million. As always, do remember insider buying is what we consider a very bullish signal, as insiders theoretically just buy because they believe the share price will go up, something that the great investor Peter Lynch has said. Now, in terms of this company, we do get a double buy rating from both Seeking Alpha and Wall Street, although we do know a hold from Quant. It is trading in the upper end of the 52-week range with a forward yield of 3.32% and a forward P that does sit around 12.35. Now, over the last 12 months, if you are a shareholder, you would be up just under 10%. Bear in mind, if you reinvest your dividends, you would be up marginally higher. And we do note over the last 10 years, you would be up around 11%. Again, not the greatest performance, but it does depend at which point you bought it. As we can see, those COVID lows, you would have been able to pick up the company at under $35. In terms of dividend safety, well, it does sit an 80 safe score, which is what we like to see. And in terms of their latest increase, 4.4% in October 2023. So we are anticipating an increase over the next few months. Now, typically on this channel, we do deep dives. We run through a lot of metrics for each one of these, like the free cash flow, like their sales growth, their shares outstanding, their ROICs. Today's episode, we are going to forgo this, but if there are any of these companies that you do believe warrant that in-depth analysis, do let us know. So jumping into the valuation model for Exxon Mobile, as always, we will run it through. We're not going to do the in-depth dive where we look at each one, but as you can see in our analysis, we do typically go through each model. Today's episode, the intrinsic value of Exxon then does come to $114. Now, what we normally do is we start off with a margin of safety at 10%, which we execute on if we believe it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for Exxon Mobile, well, it is a buy at around $103. So what this signals to us right now, as we can clearly see, that our current price is pretty much around the intrinsic value we have calculated. So we do believe this company is trading at its fair value with 0% margin of safety. Again, 10% MOS would be a buy at 103. For those looking at 15%, around $97, which is around its 52-week lows. In terms of Wall Street and their forecast, well, over the next 12 months, they disagree. They believe there is a lot of upside, 18% in fact, and their price target $135. As always, do let us know your thoughts in the comments below. Before we do move on to the next stock, just to let you know, we have released our latest free weekly article. We're looking at 10 undervalued companies with phenomenal balance sheets. If you want to sign up completely free, click on that pinned comment below. You will also gain instant access to all of these other articles, as well as many, many more. We then move on to the next one, which is Occidental Petroleum. Now, this is a Berkshire Hathaway purchase who are 10% owners. They again bought around 10 days ago, just under 3 million shares, and as we can see here, for a total of $176 million. They have continued to increase their position, as we have seen in previous episodes. They are continuing to buy month on month, quarter on quarter. We then get one buy rating. It is from Seeking Alpha with a double hold from the other 2 analysts. It is trading in the midpoint of the 52-week range, a lower forward yield than Exxon Mobile, 1.4%. In terms of a forward P, it does sit higher at 16.41. And over the last year, again, a very similar return, up nearly 10%. Over the last 10 years, however, this one is down around 36%. We also do get a borderline safe score of 60, but we do note that they did increase their dividend just in December at a very strong double-digit rate at 22%. Now, when we talk about this company and we do take a look at its intrinsic value, we can see that based on these three models, they do come fairly similar, and it does come to a value of $75. So with the current price at 63, unlike Exxon Mobile, we should get a nice MOS. At 10%, a buy up to $67. At 15%, pretty much at that current trading price. So if that is sufficient for you, it is a buy around $63, $64. In terms of Wall Street, well, they also pretty much see the price forecast over the next year around our intrinsic value. They see upside of 14%, marginally lower than what they did see for Exxon Mobile. The next insider buying that we have, in fact, is a double buy. We have 10% owner Charles Johnson of Franklin Resources make a buy on the 18th of June, 100,000 shares, as we can see, just over $2 million. Another tranche of purchases was performed just a week ago, again from the same owner, 200,000 shares, as we can see here, for just over $4.5 million, taking his total to just under $7 million over the last 2 weeks. In terms of this company, well, interestingly, we do get a double sell from both Wall Street and Quant, a hold from Seeking Alpha, and it is trading right there towards its 52-week lows with a higher yield than the previous two, 5.46%, and a forward P lower as well, 9.21. Over the last 12 months, well, it is down nearly 16%. Over the last 10 years, we can see in a massive downward trend, negative 58%. When we then take a look at this company, it does have a safe score of 70, always good to see for when companies have yields over 5%, and it has had just below that inflationary increase that we like to see on the dividend at 4%, with them coming in at 3.3 December 23. So Franklin Resources, when we do take a look at the valuation today, bearing in mind did have that double sell, we can see every single valuation model pretty much around that $25 mark, hence the intrinsic value $25.30. Don't forget as well, you can grab a copy of this model by clicking on that pinned comment below, getting to your own analysis, your own intrinsic value, and acceptable buy. So margin of safety at 10%, then we can pretty much see a buy up to $23. At 15%, not too far off. So for Franklin, we do get around a 10 to 15% MOS level. In terms of Wall Street and what they see, well, again, they pretty much have their price target in line with our intrinsic value, upside of 15%. We then move on to Salesforce, where insiders have continued to buy this. We did review it after it did drop massively after earnings, where we did say it was a very strong buy. Again, Director did in fact buy shares just a week ago, over 2,000 shares for around $500,000. So again, another very bullish sign for Salesforce, continued insider buying, and we can see it has picked up from that 52-week low, now in the midpoint, with a double buy Seeking Alpha and Wall Street, with a hold from Quant, and a yield, although very marginal, 0.16%. Forward P of 25.5. Remember, S&P sits 22.5. Over the last year, it is up 21%, but as we can see, due to the drop from earnings, year to date, it is down 4%. In terms of dividend safety, now we don't have a score due to the fact that they have just recently started to pay dividends, but when we have historically looked at this company in depth, it does look like due to the low free cash flow payout, that dividend should increase very nicely year on year. In terms of the valuation price, well, we are getting to $321 as that intrinsic value, with the current price at $255. Now we just want to explain where we got this intrinsic value for those that didn't watch the deep dive. We essentially run it through the discounted cash flow model. We had 3 different growth rates, a low, a medium, and a high, and we decided to take forwards the growth rate at 10%, the medium rate. Therefore, this value is on the fact that if they are able to sustain increasing their free cash flows at 10% year on year. In terms of margin of safety, at 10%, a buy up to 289, 15% up to 273, and we can see even though it has recovered from that lows, it is still a 20% MOS level. In terms of Wall Street and their estimations, while they do believe there is upside, not as high as our intrinsic value, $304, 19% implied over the year. And as always, do give us your thoughts below. You could argue we have left the best till last, Marvel Technology, with the director who did buy literally 4 days ago 1,425 shares for around $100,000. Now, when we do take a look at this company, we get a strong buy from Wall Street, a buy from Seeking Alpha, a hold from Quant. It is trading in the midpoint of the 52-week range. Forward yield 0.35% and a forward P 49.05. Over the last 12 months, well, up 14%. over the last 10 years, we can see up 367% and has outperformed the S&P during that period. Now, in terms of dividend safety, one of the lower ones here, a 42 borderline safe score, and we are still waiting for a dividend increase for the last full year. So in terms of this company, well, why we like it is because we believe there is a lot of headroom, a lot of upside as well. In terms of the DCF, well, $90 is coming to that intrinsic value. And what we can see here, with the current price around $69, the margin of safety should be very nice. So 10% a buy up to $81, at 15% around $76, at 20% $71. So not quite at that 25% level, sitting somewhere between a 20 to 25% MOS for this company. And what is also nice that we like is the fact that Wall Street, with their price prediction, do see it around that intrinsic value that we have calculated. They believe upside of 32%. As we saw earlier, a very strong buy. So this could be one that we do a deep dive in the future if this is something that the community want. As always, let us know your thoughts about these 5 companies. We had Exxon Mobile, we had Occidental Petroleum, Franklin Resources, Salesforce, and Marvel Technology to end the episode. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button, let us know your thoughts, and as always, we'll see you all on the next one.